Welcome to the debate. Our discussion today centers on one of the most compelling and frankly counterintuitive findings in the economic theory of choice under uncertainty. We're analyzing the core decision of how a consumer maximizes their expected utility when selecting an optimal amount of risky investment.
And the central paradox we're really confronting is the behavior predicted when the government imposes a simple, proportional tax on the returns from that risky asset.
Absolutely. The core question that emerges is profound because the source material presents a shocking result. Does the expected utility framework yield a practically robust conclusion that taxing investment returns actually encourages increased exposure, or does this finding expose a crucial, perhaps limiting, theoretical boundary of the model itself? It's wild, isn't it? A tax that encourages putting more capital at risk.
That a tax increases investment is so profoundly counterintuitive that it just demands intense scrutiny. I mean, we have to look at the highly abstract assumptions required to produce it. I contend it's really an artifact of the mathematical structure.
And I'll be arguing that this result is a precise and powerful demonstration of the model's ability to analyze these intricate risk trade-offs. It proves its internal consistency in a way that, policymakers have to reckon with.
And I will challenge the practical and conceptual implications of this scaling factor, suggesting it might mislead us about real-world investor behavior.
So my position rests on the foundational principle of expected utility maximization for a risk-averse consumer. We model risk aversion using a concave utility curve, meaning that marginal utility diminishes rapidly and losses hurt disproportionately more than gains satisfy. The consumer chooses an optimal investment amount, let's call it X, that balances the potential for a high return against the pain of a low return or loss.
Right. And the maximization goal is to find that perfect mix between the utility they get in the good state, WG, and the utility they keep in the bad state, WB.
Precisely. Now, when a proportional tax rate, T, is introduced on the returns, the after-tax returns are proportionally reduced. This happens across both the gain and the loss scenarios. Crucially, the tax acts in two opposing ways. It reduces the potential upside, which is a disincentive, but, and this is the key point for the risk-averse consumer, if a loss occurs, a negative return, the after-tax loss is proportionally smaller. The government, by taxing returns, essentially shares the downside risk.
It dampens the volatility.
Exactly. This risk mitigating effect is highly valued. So the model proves mathematically that to return to their preferred pattern of risk and return, that is, the ratio of marginal utilities across the states, the optimal after-tax investment, which we call X hat, must exactly equal the pre-tax optimal investment, X, scaled up by the factor 1 minus T. The consumer, rationally increases their gross exposure, X, to exactly offset the tax's dampening effect. It's about maintaining the desired after-tax utility profile. It shows the framework perfectly handles these complex risk adjustments.
I see why you think that, and I fully concede the algebraic validity of the proof. The math, coming from the first-order conditions, forces us to conclude this scaling happens. But what is the consumer actually doing in the real world when they scale X up by 1 minus T? That's the conceptual necessity I want to challenge. The consumer's utility depends on their net wealth distribution, sure, but the tax forces them to commit significantly more initial capital X to the risky asset.
But they must increase the input X if they want the output utility mix to remain optimal. I mean, the taxes change the price of achieving that mix.
That forces the consumer into a highly abstract behavioral position. The model assumes the consumer must increase their physical capital exposure by a factor greater than 1 just to achieve the same absolute utility levels they targeted before the tax. This, for me, reveals a limitation. The consumer is only concerned with the relative pattern of after-tax returns, and they're neglecting the fundamental constraint of needing increased real capital exposure. I mean, if the tax rate is 50%, they have to double their investment commitment. This assumption that capital is just infinitely available and frictionlessly committed is what diminishes the model's practical predictive power.
Let's talk about that real constraint versus the model's logic. you question the interpretation of this risk reduction as a practical benefit. But the tax structurally reduces volatility. If RB is a negative return, a loss, then the after-tax return 1 minus TRB is a smaller absolute loss. This is in effect risk sharing with the government. Since the consumer is fundamentally risk-averse, this reduction in the magnitude of the bad state outcome is, well, it's highly valued. The investor increases X not because they love the tax, but because they're leveraging the decreased volatility to achieve their new optimal point, where their risk tolerance is perfectly balanced against the new market conditions.
That sounds elegant in theory, but consider the human cost. For the cautious investor, the benefit of reduced volatility is inseparable from the requirement of increased capital commitment. It's like we're asking a cautious driver, after installing a new safety system, to suddenly buy a much bigger, faster car just to maintain the exact same cruising speed and internal feeling of safety. If the tax is 50%, the model demands they double their investment. If the consumer only has initial wealth W and X gets large, they are risking a far greater portion of their core capital just to replicate a utility profile. The model is just silent on the emotional discomfort or the actual liquidity issues that this massive scale-up would impose.
That's a powerful analogy, but I would argue that the consumer, within the expected utility framework, doesn't experience that discomfort. Their preferences are defined only by the utility curve itself, which is what we call time consistent. This result ties directly back to the robustness of the independence assumption. The consumer's maximization problem focuses solely on the additive utility across states, good and bad. The tax simply acts as a filter on the returns. It changes the required input X to achieve the optimal output utility mix, the WG-WB pair. Because the tax effect is a linear, proportional reduction on both sides, the consumer just scales their input X up perfectly to undo the linear filtering effect and return to the original utility trade-off.
I agree that the math is clean because a relationship is linear, but this suggests the result is less about deep behavioral principles like the independence axiom and more about the specific structure of the fiscal tool being used. This proportional scaling, this $1, 1 minus t, stems entirely from the specific, non-stochastic nature of the tax being imposed only on returns. If the tax structure were even slightly more complex, say if it introduced nonlinear administrative costs, or if the tax was contingent on market volume, or, crucially, if the tax was placed on the initial capital X itself, this elegant scaling would immediately fail. The result is so sensitive to the linearity of the policy that it feels more like a specific mathematical property of the model rather than a general rule about how investors truly respond to fiscal policy.
But that is exactly why the finding is so valuable. It provides a clear, actionable prediction under these specific, standard fiscal conditions. It offers crucial nuance. Not all taxes on investment necessarily discourage risk exposure. This is a profound theoretical finding that expands our understanding of risk-utility trade-offs. The model shows that a policy designed to raise revenue on investment returns might actually be leveraged by risk-averse agents seeking that optimal equilibrium. It's a powerful demonstration of the model's capacity to reveal these non-obvious outcomes.
But policy implications have to be grounded in realism, not just theoretical elegance. If the policy goal is to reduce speculative investment, this model predicts the opposite outcome. Furthermore, the theory relies entirely on the assumption that the consumer will access the extra funds, the X dollars, required for the scale-up. Imagine a 50% tax rate. The consumer needs to double their gross commitment, X dollars. If they cannot or will not access that extra capital, the model breaks down entirely. The policy could therefore simply exclude investors who are capital constrained, even if they are fundamentally risk-averse, demonstrating that the model, while elegant, risks providing highly conditional and, potentially misleading policy guidance.
I reaffirm that the precise mathematical relationship is a testament to the power of expected utility maximization in modeling choice under uncertainty. The consumer rationally adjusts investment to leverage the built-in risk-reducing aspect of the tax while maintaining their desired utility profile. The model requires increased exposure, Because in a world governed by expected utility, a tax on returns is effectively a mandated proportional risk reduction scheme that must be compensated for by increasing the size of the underlying exposure.
And I conclude that, while the proof is internally consistent within the expected utility framework, this highly counterintuitive finding serves as an important warning. The requirement for a risk-averse individual to significantly increase gross investment exposure X to accommodate a simple tax gravely questions the model's reflection of real-world capital constraints and the psychological complexity of committed risk. It is, at the end of the day, an abstract theoretical endpoint.
We can certainly agree that this discussion illuminates the powerful trade-offs inherent in modeling financial decisions under uncertainty, and it shows the need for clarity when defining how policy interacts with risk.
And that the foundational text offers much more to explore regarding how financial institutions like insurance and the stock market are ultimately structured to mitigate these inherent risks, through concepts like diversification and risk spreading.